Welcome to The Explainer. So let's talk about the AI paradox. It's this incredible story of massive hype, soaring stock prices, but just beneath the surface there's a whole series of hidden risks that are quietly and fundamentally rewiring our entire financial system. Let's get into it.
Everything kind of came to a head on this one day, January 27th, 2025. That's when NVIDIA, the undisputed king of AI chips, suffered the largest single-day loss in U.S. stock market history. It was a total shockwave that made everybody ask a really critical question. Is this AI boom built on solid ground, or is it just a giant bubble that's waiting to pop?
You know it's serious when even the biggest players, guys like Microsoft CEO Satya Nadella, start sounding the alarm. His warning the companies need to deliver real value, not just promise it, well, it sounds an awful lot like the fears we heard way back during another era of tech-fueled craziness.
Okay, so that's the big question, right? Is this whole AI frenzy just déjà vu? Is it a repeat of the dot-com crash that wiped out trillions of dollars 25 years ago? Or is something fundamentally different happening this time around?
So here's the crucial difference. While both eras had just incredible hype, the way they're financed is completely different. The dot-com crash, that was a valuation bubble. You had companies like Cisco basically lending money to unprofitable startups just so those startups could buy Cisco's gear. It was a total house of cards. Today, it's what's called a capacity bubble. The biggest tech companies are using their own massive piles of cash to spend hundreds of billions on AI data centers. It's this huge infrastructure build-out that's completely disconnected from how much money AI is actually generating right now.
But beyond that big picture stuff, there's a much more deceptive trend starting to pop up. It's kind of the first layer of this whole AI paradox, and it goes by the name AI washing.
AI washing is pretty much what it sounds like. It's when companies talk the AI talk, but they don't actually walk the AI walk. They just sprinkle the letters A and I all over their reports and presentations, hoping to get a quick stock bump from all the investor excitement.
And wow, just take a look at this. This chart shows the absolute explosion in what researchers call AI talk. Since early 2023, the number of companies name-dropping AI in their earnings calls has just gone vertical. You can literally measure the hype, and believe me, it is off the charts.
But here's the catch, and this is where the lie really comes in. This chart shows actual AI washing incidents. We're talking about cases where a company talks up its big AI strategy and then makes zero AI-related hires for the next 2 years. That trend line? Man, it looks almost identical to the AI talk chart, doesn't it? It's basically proof that for a lot of these folks, talk is cheap and they're just trying to cash in on the hype.
So why do they do it? Well, if you follow the money, the research shows a pretty clear reason. It turns out managers whose bonuses are tied directly to how the stock performs in the short term, they're way more likely to engage in this AI washing. It's a strategic move, right? Puff up the stock price, hit your targets, and get a big payday, whether you actually innovate or not.
Okay, so that's the fake stuff. But what about the companies that are genuinely investing? The ones putting their money where their mouth is? Well, that brings us to the next layer of the paradox, because even for them, there's a painful hidden cost that's hitting their bottom line hard. People are calling it the innovation tax. Think of it this way. It's the massive, upfront cost for all the GPUs, the brilliant data scientists, the new infrastructure, the whole shebang. A company has to pay all of that before it sees any of those promised productivity gains. You're paying the tax long before you ever get to reap the rewards.
And let me tell you, this tax is steep. One study in the U.S. banking sector found that the average bank adopting AI saw its return on equity, which is a huge measure of how profitable they are, fall by a staggering 428 basis points in the short term. I mean, that is a massive, massive hit to their profitability.
Now here's where it gets really interesting. This slide shows a clear digital divide. While the big banks took a painful hit, 129 basis points, the smaller banks got absolutely hammered. We're talking a 517 basis point drop. They just don't have the scale to absorb these giant upfront costs. And it's creating this two-tiered system where the big guys get bigger and the small guys are just trying to survive.
So all of this widespread, expensive investment creates what might be the deepest and honestly the most dangerous layer of this paradox. It's not just about hype or cost anymore. This is about a fundamental rewiring of the entire financial system itself. Experts have a name for it: algorithmic coupling. It's this new kind of invisible way that financial institutions are all connected. They're not just linked by loans anymore.
Now they're becoming linked by the very logic of their AI models. Because so many of them are using similar AI building blocks and training them on similar data, they are, for all intents and purposes, starting to think alike.
And just look at this map. It really shows you what's happening. The red dots are the banks that have adopted AI. See how they're forming this dense, tightly connected core right at the center of the financial system? They're not just buying a new piece of software. They're creating a synchronized cluster where everyone's decisions are becoming deeply and dangerously intertwined.
And that's the danger. This creates a brand new way for financial disaster to spread. Think about it. A single bug, one data poisoning attack, or even just one flawed assumption in a popular AI model. It could trigger a cascade of identical, terrible decisions across that entire core of banks, all at the exact same time. It's like a domino effect on hyperspeed.
So, after all of that, what's the big takeaway? What is the true risk of this AI financial boom we're living through?
See, it's not just one single threat. It's this dangerous combination, this perfect storm. You've got the capacity bubble funded by big tech, then you have corporate deception with AI washing. On top of that, there's the very real and painful innovation tax, creating a digital divide. And finally, all of this is building a new, hidden fragility in the system from algorithmic coupling.
Which leaves us with this one final provocative thought to chew on. As we race to build this new technological frontier, we really have to ask ourselves, are we actually making our financial system smarter and more efficient? Or are we just inventing a faster, more complex, and maybe even a more elegant way to fail?